my name's Michael Pate. Today I'm doing the podcast for the short working week starting the 27th of August in Paul Kavanagh's absence. This week is a relatively quiet week for corporate results. We're going to have a lot more macro numbers this week. Just a quick recap on last week. We had the FOMC meeting minutes last week. We were looking for whether the Fed were going to give signs of concerns about disinflation, which they didn't. Concerns give further guidance on the numerical thresholds for change in policy, which they left the same, and also give us, the market, some sort of further guidance on tapering, again, which they didn't change at all. So we're still expecting tapering to be at the September meeting, which will pull back the QE that's currently in force in the US economy. That was broadly seen as slightly negative for markets, and what we saw last week was the 10-year Treasury yield starting to rise. This morning we've had some figures from the US, the durable goods numbers, which came in below expectations. Yesterday's market, actually, there's a strange dynamic. That number came in poorly, and the market went up, showing that actually the market is looking for poor numbers to push back QE and bring down the 10-year Treasury yield, which will be supportive to the consumer growth and mortgage numbers in the US. Also last week we had the Chinese PMI. That again came in ahead of expectations, just above 50. That's another number in a series of numbers that have been positive for the Chinese economy, which is reinforcing our sense that the 7.5% GDP growth rate that is in the market can be achieved, which was also supportive for the mining sector. So better week for China last week. This week, as I say, the US results season is drawing to a close. Just a quick recap on that. Overall, revenues came in 1% above expectation. Earnings came in 3% above expectation. The sectors that outperformed, have got the earnings momentum at the moment in the US in the second quarter were financials. We also saw that in the industrial sector and healthcare. Technology was broadly flat, came in line with expectation. Materials, energy and telecoms were below expectations, broadly sort of reflects the poor share price performance we've seen in those sectors over the last couple of months. Going forward into this week, it's quite a big week for the US in terms of economics. Today we've got the Case-Shiller US Home Price Index, and we've also got a confidence figure for the US. As you can see on both of those charts, house prices have been rising quite aggressively this year, and with that consumer confidence starting to be more positive, that's been very supportive to US consumer-facing stocks, and that's an area that we've been relatively active in because of that sort of firm backdrop. We're also seeing this week, we saw this morning actually, the German IFO business confidence number, which came in ahead of expectations, again supportive to European cyclical recovery. And later this week we've got the Spanish current account number, which is a really important number for gauging a barometer for the economic activity within peripheral Europe, which is the sort of big swing factor in Europe at the moment. Lastly, this week we've got some PMI numbers from Japan, which we've had a series of slightly poorer numbers from Japan, so we'll be hoping for a slightly firmer number there. So here on this chart we've got the economic surprise index, which basically at zero, macroeconomic numbers are coming in as economists' expectations. If they beat expectations, you get a number above zero. Below that, obviously they've missed expectations. So you can see that in the US and Europe, you've been seeing a strengthening economy ahead of economic expectations. In Japan, things have got slightly ahead of themselves. So that's been pretty supportive for our base case, which is the US and Europe will continue to accelerate into the third quarter. A lot of that has started to be priced in. Essentially, expectations are around 2.8 to 3% GDP growth for the year, which translates to around 15% EPS growth, which is largely what the market is looking for and would be supportive to markets. What's offsetting the strength that we're seeing in the developed market economies is the emerging market weakness. You can see in this chart that emerging markets performed pretty poorly in relation to developed markets, and that's largely been in response to quite a lot of hot money coming out of emerging markets because of US Treasury yields going up. So economic policy in the US is affecting emerging market performance, which is something the emerging market central banks are starting to get slightly concerned about, and they're talking about it in Jackson Hole at the weekend. Where we are in terms of the effect of that is that emerging market currencies have been very weak. So looking at the Brazilian real here against the US dollar, you can see it's been very weak this year. Had a further leg down, and we've got an interest rate decision on Wednesday from Brazil, and they're probably looking at raising interest rates in order to protect their currency and start to strengthen that a bit, because they're seeing quite a large outflows of funds from that economy. Also, within the emerging markets, we've got a GDP number in India coming out this week. Again, that has been revised downward over the last couple of quarters, and so we're in a position in emerging markets where you're seeing weaker GDP growth, but also rising interest rates. So that's probably going to cap near-term performance of that market, and that's why we're favouring developed markets at the moment. This week overall, we would hope that the consumer data from the US is going to be supportive to our US consumer stories, and we'll continue to see that sort of business cyclical recovery in Europe being supportive to those sort of industrial European businesses we're running in portfolios. Also last week we saw some continuation of the outperformance of the AIM index against the FTSE 100, which has been an interesting thing to watch since the UK government changed their policy on allowing AIM stocks into ISAs, so that market has been a lot firmer since then. I expect some continuing of that. On the corporate news, we have got WPP and Serco on Thursday. WPP, we expect low single-digit top-line growth with some margin expansion. Because of this sort of slightly better tone to the global economy, we expect a good outlook statement, which will be widely watched. On Serco, again, looking for organic growth coming through, looking for some further evidence of the US pipeline building to offset the electronic monitoring problems that they've had for that stock in the last couple of months. And finally, we've got Gemalto, which is another Killik stock. This one is probably going to be second half weighted in terms of profitability, which is probably why the stock's come off a little bit after a very strong run into their figures. In terms of guidance, Q2 should be sort of low double-digit growth rates, but I think we'll get firmer guidance on the 5th of September when they have a capital markets day in New York, and they'll be giving long-term guidance on the company then. So that's it for this week. Thanks very much.